You command a very venerable and famous institution. Goldman's alumni are around the world running financial institutions, but also treasuries, central banks, everything else. What's the secret of Goldman Sachs?
The new Prime Minister of Australia.
Prime Minister of, I was going to ask you about Malcolm Turnbull. It's you have. What's Goldman's secret? I mean, how does this institution manage to be such an extraordinarily dominant financial institution, but also attracts these extraordinarily talented people who go on to do remarkable things? What is it?
You say attract them. I was hoping you'd think manufacture them.
Well, manufacture, or actually, maybe,
develop.
or you spit them out. Maybe
develop.
They spit them out. And they go and run other places.
No. We've always had again. We're pretty focused. We're very different from the other big banks. We're really just focused exclusively on investment banking stuff, relatively small. We've always been in the, we would like to think, it became, government service following your career in a banking business. That became a kind of a pejorative description in the financial crisis. It became, Goldman Sachs was an accusation. We always thought, in fact, in my earliest days in the company, when I became a partner, I had an interview with somebody, those were in the days of the partnership. You got to put money into the company. You didn't take money out when you first became a partnership. And in connection with that, he said, there are two things that you need to do from the get-go. One is you have to establish, I know you don't have any money, but you have to establish a private foundation. You're expected to use it. And the other thing is you should organize your career so that if and when they write an obituary about you, and it's 9 paragraphs long, no more than 2 or 3 mention Goldman Sachs. You're supposed to do something afterwards, and you're supposed to go, and that usually was go to a foundation or go into government service. So that was always very much embedded in the mix. And as a result of the financial crisis and a wave of populism that hit after that, which is, which I think to some extent we're still in, it became a bad thing for people to go from the business side into, and particularly from Goldman Sachs, to do that. And so one of the reasons why there's a lot of attention by where our alumni are is it became something that became an accusation and not a compliment.
Why do you think people, again, Goldman attracts a lot of respect. It's fair to say it attracts a lot of opprobrium too, I think, around the world. We're all familiar with the now infamous description of Goldman by a Rolling Stone writer as a giant vampire squid wrapped around the face of humanity. How does it? I think you remember. I think
it was a giant. They're actually quite
was it
small.
just the vampires?
Yeah,
because they're quite small, sorry.
Yeah.
But what is it about? I mean, again, an institution, there are a few, I think there are probably, it's fair to say.
The Wall Street Journal crediting Rolling Stone's business commentary.
Sorry, okay. But it's the kind of phrase, it's the phrase I wish, not in the context of Goldman. Not in the context of Goldman, Lloyd, but it's a phrase I would have liked to have come up with at some point in my writing.
It gives you something to aspire to. You could be Rolling Stone in finance.
But why do you attract, for an institution? I can't think of any corporation that probably does attract as much attention. Some of it good, and some of the reasons we've talked about, because some of the extraordinary success that you've had. But also, it does seem to attract a tremendous amount of resentment and even opprobrium. What's that about?
Attention. Look, this is to some extent, this is the world we're in. My last 5 predecessors went into government service. I don't think that was such a bad thing, but they'll get criticized. I mean, Hank Paulson could get vilified for making a contribution in saving the financial system, and then Bob Rubin, how could you 25 years ago have done something for the mere fact of people's status and stature and contribution opens people up to criticism. And I think we're in a particular wave of anti-institutionalism, whether that's the Boy Scouts or the Catholic Church or venerable investment banks. There's a wave of that. And I guess, and I think in the American culture, there's been waves and waves, and it goes back a long way, of resentment for concentrations of financial power. Whether it was, goes back to, Hamilton and Jefferson and the Bank of the United States and all through history. And
William
I think
Jennings Bryan,
obviously the Depression and J.P. Morgan testifying and all that kind of stuff. Look, we didn't even have a central bank till the early 1900s. There are people who don't want to have one now. notwithstanding the volatility in the So that's a thread that kind of runs through it, and that's going to be a thing that's going to always happen, this is not the end of that. If there's another financial, people will get, for the next business cycle, somebody will, finance will get blamed for, what is a predictable cycle.
The culture of Goldman Sachs, it does seem a very meritocratic institution. You yourself, you've talked a little bit about this, your own background. You came from very, very humble beginnings. At one point in your life, you sold hot dogs at Yankee Stadium. I know that's an old story.
Well, that wasn't the worst of it, yeah. But
tell us.
Watching the games at Yankee Stadium in those years was the worst of it.
Well, they're not doing so bad this year. But
I grew up in the projects over in East New York, Brooklyn.
And is that Goldman does seem to have a knack of pulling out highly talented people from whatever their background and actually ensuring that they become part of that success.
I think if you look at, notwithstanding the rhetoric that flies around, if you go look at the people at the other firm, my friend James Gorman was one of 10 kids, grew up in Australia. My predecessor, Hank Paulson, grew up on a farm. So did actually Corzine in a neighboring state. I just think that's a pattern. Again, you look at the Forbes list, how many of those, there's some families there. I remember when that list first came out, it was number of Rockefeller, people, family wealth, multi-generational family wealth. But if you look at that list, a lot of people in this country or something, it's one of the great strengths of the country. And I think just people don't have an appreciation for how much mobility there is in America, notwithstanding all the charges that those paths have been calcified and blocked. I just think that I think that defies experience.
Maybe it's just because I'm English by birth, and this meritocracy thing takes a bit of time to get used to it. I suppose we're not really that familiar with it. But is that still true of America? Is that still true of America? Because there's lots of evidence that mobility, that social mobility in this country is actually declining pretty rapidly.
Look, you can find a ton of. You can go on and look. It's both, and like everything else, you can find support on both sides because there are elements of both sides that are true. The gap. I'm not going to argue the statistics about whether certain measures, concentration of wealth, divergence between the upper quartile and the lower quartile, and so in other words, expanding inequality, and that's all true and has to be dealt with, and is a source of, I don't know if it's instability. It tends in that direction, and certainly creating a noisy presidential campaign, but at the same time. Adjacent to that, you have a situation where it has never been easier for people to start a business. That if you're, again, we're dealing in a rarefied world, and maybe this isn't the generic, and maybe maybe I'll be accused of talking about just such an exceptional set of situations. But if you're a kid getting out of school today, and 15 years ago you had to raise $5 million or $10 million to start a business, today you have to raise $10,000 because you can rent your computers from Amazon. You can get your space at a kind of an internet, like a WeWorks. You can get staffing, and you can do things very much on the fly. And look at how much entrepreneurialism that's developed. And so you have both sides of that represented.
Obviously, there's lots of interesting topics in the markets and with Goldman and the financial system. One quick other question on Goldman culture, though. What do you look for? Again, you do have a capacity to hire some of the smartest people around. You get really, really good people who come and work for you. We had Steve Schwartzman at Blackstone here, one of the sessions here a few months ago, and he said a very interesting thing. He said this, I quote him, he said, "To be hired at our place and work with us, you have to be nice. I don't like people who are not nice." He said it's more important for them to be nice than to have an MBA. What about how would that work at Goldman?
You have to get along with people, and you have to be effective, and you have to make the people around you better, not worse. If you are not easy to work with and a poor team player, whatever deficiencies you cause in other people by your bad behavior is a negative against whatever you would contribute. So the way I would say it is, we probably have people that cover the spectrum. But if you're not going to be very cooperative, you're not going to be a team player, maybe generically, if you're not going to be nice and get along with people, you better be very, 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 very good at your job. And
I'm going to ask you to identify.
And by the way, all the time.
Okay, I'm going to ask you to identify those of your senior colleagues who are not nice, but very, 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 very good at their job. No, I won't.
I will have to tell you, they all seem very nice to me.
And to me too, the ones that I've
exactly.
Let's move on to, so we are at a very interesting week. You've spent a lifetime in markets. You're a very successul trader yourself. The very important week, tomorrow we'll get the Fed's decision on interest rates. Everybody's waiting with bated breath. The market seems to think they're not going to do anything, but maybe they'll do something else. So my question to you is, should they now raise interest rates? Is it time finally for them to raise interest rates after 9 years? Or not, and will they?
Yeah, I think in the absence of other things that would displace that on the headlines, and by the way, if anything did displace it in the headlines, it would probably be about us, so I'm not unhappy that we're all focused on that interest rate decision. I'm not sure how consequential it is. I think everybody has visibility into everything. And if the decision gets made, it's not because there's a tsunami of evidence of a hardening and quickening recovery and tightening of labor and acceleration of inflation. Nobody thinks that. It's just almost a question of wanting to get over that hurdle. And on that basis, that's probably not a reason to do it. So I just don't think it's all that consequential. We'll look back and people will say, was it really consequential whether it was September or December at the margin, 25 basis points or zero? Is that going to be so consequential? Probably not. But if I had that job, and I would like to think that they did this, the idea that I'm tired of rates at zero, this kind of soft, let's get it over with kind of stuff, should really give way to the hard data evaluation. And the data evaluation isn't compelling an interest rate rise at this point. So I'm not saying it's so meaningful and so consequential, because I don't really think it's that dramatic on one way or another, because it's not as if if they do it, they'll say, my gosh, what do they see that we don't see? I think we're all seeing the same things, and it's not that big a difference. So I wouldn't do it unless I was compelled to do it, because I'd want to have blinders on, because once you get pulled by, gosh, they've been low too long, and gosh, these kind of soft things, it really enters into, the pressure and the politics, and I think it should be data driven if you're the Fed.
And you don't think the data's there right now to justify a rate increase?
It doesn't seem to be.
But this always seems to be the problem we seem to be in. For the last few years, the Fed has had this extraordinary accommodative monetary policy for a long time now. Whenever it looks like they're going to back away from it, we had the taper tantrum 2 years ago. We've had now, as we come towards what looks like a rate increase, it seems to send the markets into a funk. And everybody says, oh, well, the Fed can't do anything now because the markets are in a funk, and we have to keep putting it off. Isn't there a case for just saying, look, the Fed should just remove the uncertainty? You've got to get out of this extraordinary position at some point, because at some point we're going to have another recession, by the way, and you're going to at least want some room for maneuver.
Well, I wouldn't trade uncertainty for the more consequential and adverse risk. Look, it's the risk and the consequences of going too soon and hurting the recovery is vastly disproportionate to the consequences of taking a little bit more incremental inflation risk. There's a playbook for dealing with inflation. There's no playbook for dealing with deflation, especially now when you don't have a lot of tools. And I would say that the Fed has, in a lot of ways, have tightened. We've gone through, over the last couple of years, income tax rises, which is deflationary. The abandonment of QE, all of those were kind of deflationary steps. We didn't necessarily balance the budget, but we set the revenue and the revenue and the expenses on a path to narrowing. That's a deflationary corrective step that people wanted to see, that we have seen. We have a lot of accomplishments under that belt. Compare that to Europe, where the lines continue to diverge. And so we've worked our way through those things. I mean, gosh, if we wanted a deficit spend again, assuming you could legislate, we could be in a position to do that, because we're in a path of convergence on the deficit. So We've done a lot already. I don't think you have to make this incremental step to prove your bona fides or just because there's ennui with the current pattern.
But the Fed raised rates. Where would you've been seeing these market situations for a long.
By the way, they may well raise rates at 25 basis points. I just don't think
it's going to have a big.
I just don't think it's worth the ink.
If they did raise basis points by 25 basis points, you don't think that would have a big effect this week?
Well, they'll raise it by 25 basis points, and for sure they'll remind everyone about how gradual they'd expect the trajectory to be, and it's going to be like this for a long time. So what's really the difference, and everybody would be speculating? Actually, all those promises and commitments will give way to any change that we have in the data.
So what's the problem? So what are the? We've had an incredibly turbulent month in markets. We've had extraordinary volatility spiking to levels we haven't seen in the last few years. You've seen extraordinary events out of China. There's been significant moves in currencies. A lot of emerging market currencies getting absolutely hammered. U.S. equities have been hit pretty hard, not as hard as Chinese, but have been hit pretty hard. So what's all this? What are we going through? Is this just what is this just a late summer kind of volatility?
We're on the cusp of look. We had zero interest rates for a very long time. We're on cusp of a change, and with that kind of change is usually consequential, not for the 25 basis points. Look, what I would really like to have happen is I'd like the Fed to raise rates because they say, and we agree, we look at the data and we say, my goodness, we're on the path of a solid recovery and it's going to accelerate. That would be a very, very benign rate raise that would accommodate the fact that the economy would be growing so quickly. That's what I would like to see. And we're kind of on the cusp of these changes. And when you're on the cusp of the changes and you're data dependent, gosh, you get one number, and all of a sudden it's like the last straw. It's like the tipping point. And when you're at the tipping point, and you start and you discount all, the value of all assets and goods and services and the path of, future rate changes by that morning's unemployment number, and all of a sudden you get dramatic moves on what could otherwise be in a different context where it's not a tipping point, otherwise, a ho-hum event. And so we're kind of seeing that. And, let me also put it into context because you had a long, your predicate description of really what we've gone through. I mean, the equity market is not that far off the highs. It really hasn't been, we have had extraordinary, flashy kind of volatility in an otherwise low, in a low volume market. But most of what we've seen, like for example, the most dramatic thing we've seen is the drop in commodity prices, and that wasn't a flash. That's kind of been a trend, and consistent with increases in supply, overinvestment in the commodity space, and kind of softness in demand, which we've been talking about, especially out of China. Well, so these are all kind of explicable and not really. It's not like the market moved, 20% over a month.
Well, there's two sips. I mean, the market is down somewhat.
Yeah.
Overseas markets are down. Certainly China and other markets are down a bit more. But volatility has come up, and I want to ask you specifically.
The China market is down. It's almost back to where it was a year ago.
Sure, it's still up actually 20, whatever it is, 20%,
so it's
20%
really,
for the year.
I'm not trying to refute what you say, but I just want to put it in context.
But we have seen, I want to come on to specifically about the issue of volatility, but let's talk about China, because you mentioned China. You've spent a lot of time with China. You've got a lot of business in China. That seems to be at the root, certainly, of what's been going on in the last month or so. Real concern about the sustainability of the Chinese economy. Obviously, absolute total disbelief in the official Chinese data. And when you look at the unofficial data that give you perhaps a better reflection of what's going on in the Chinese economy, foreign countries export, other countries' exports to China, you look at all the other proxies for Chinese demand. Chinese demand seems really, really very, very, very weak, very much weaker than anybody had expected. And it seems to be that seems to be driving this uncertainty.
The low base things, the low forecasts. We think China's, they say their target is 7. We think they're growing, 6 and change, and somebody else would say 4.5, 5.
Yeah, even lower actually. I mean, if you look at some of the data, say the export data certainly aren't consistent with a 6-5%.
No. I understand, but in the context.
But that's why. Surely that's why people are much more nervous.
Right.
And
at the
why
margin,
commodity prices
China
have fallen.
again. Getting back to the thing, China represents a substantial part. Maybe 100% if you had, pluses and minuses of the incremental of the marginal demand in the world, and a lot of the the commodity flows and commodity price have been generated by China demand that's not sustained and that was unsustainable. China has one of the hardest execution issues there for an economy ever. I mean, they're going from a position where growth at any cost. I mean, 10% growth at any cost. What does any cost mean? They'll put a smoke belching factory in the middle of the city, and nobody cared about growth, headlong growth at every cost, export, unsustainable, because guess what? You get to a certain level of wealth and you have to breathe, and you can't continue. And by the way, pollution and that kind of consequence of that is cumulative, and it can't go on like that. They can't continue to drive exports and be kind of a low value creator. They have to start creating a consumer economy. You can't be in a situation, they've done a credible job of making a lot of decisions centrally, defying all reason and experience, that you can make central decisions and have a lot of them turn out to be right, but they were. But you need a market system to help allocate capital. I think the worst thing in China is you need a mechanism to write off mistakes. In China, when they wanted to pump up their economy the same way we were, when we were stimulating ours, they went out and built 82 airports at the same time. Well, probably 35 are in the wrong place and have no people that are ever going to use them. Now, if that were here, nobody would use the airport, planes wouldn't land, fees wouldn't be paid, debt service wouldn't be paid off, and eventually it would get written off, get plowed over, and they put up a Walmart's or something. And there, guess what? Still an airport that nobody's, so you have to go out and you have to create the capital market. You have to create institutional investors. If you're PetroChina and you have 1 million extra employees, how do you fire them if there's no unemployment insurance and there's no health care and everything so what you really need to do is you really need to develop those institutions. Those institutions and insurance companies become the institutional investors. The institutional investors become the capital allocators, because you have a really normal equity market instead of a contrived, controlled equity market, which is what you're seeing. But you have to bootstrap that. You have to do those things all at once. You have to develop capital markets. You have to develop a bankruptcy system. You have to develop safety nets. And it's hard to do that all at once. You have to go from an export economy to a service economy. And if you talk to people there, they know what the problems are, and they're pretty smart about it, and they almost seem, dare I say, wise about it. But it's really, really, really hard and tricky, and it's not going to get right it's going to be noisy, and it's going to be difficult, and mistakes are going to be made. But they're very, very smart. They also get good people and retain good people in China, and they're competent, and they're going to have a lot of good years, but it may not be 15 and 16. And I think it's going to, I've said this once before. This may be, U.S. had a great 20th century, but every year wasn't great in the 20th century. And this could very well be China's century, but it doesn't mean every year is going to be theirs.
But you think they're basically both the strategic direction of China, which is, as you say, shifting the economy from export investment-led towards consumption-led, and actually the execution of that is pretty good. You think they're in pretty good shape?
No,
just going through a difficult
transition.
I think it's a difficult transition, but they're handling it well.
No, it's a difficult transaction, and it looks awfully sloppy, and they're making kind of mistakes. And so they have the ham-handed way in which they dealt with the A-share market. You have wealth being created in China, but you have currency controls and exchange controls, and you're limited to what you could buy. So you could buy real estate until they clamp down on that. So guess what? You have a real estate bubble, and you have everybody speculating on equities. And so the A-share market, which is a contrivance because there's an international market out of Hong Kong trading the same companies, and the price of the A-share market is substantially higher than the H-share market. Why? Because the people in China can only buy A-shares, and so the price of that was up 100%. So that was dumb to let that happen. And then the ham-handed way they dealt with the collapse, because who are those things? I pointed out there's no institutional investors in China. It's all retail. And so when the market starts, that A-share market, that onshore market starts to crash, it's like real people that are getting hurt. So I think on the way out of the country to, on a visit, the president must turn around and say, now remember, I'll be gone for a while. Whatever you do, don't let the market go down. And so I think the regulators feel in China, unlike the regulators here, I don't think feel that part of their book and brief is to have a high price. on the market, to feel better when the price is high or worse when the price is low. But there it's not like that. And I think that people panicked and started to use the few institutional investors or government investors and I think that they, in a very, again, ham-handed way, went out and, started buying up the market and told people that, it won't be good for you if you sell, so don't sell. And of course, that creates the opposite effect, because if the government is intervening artificially in raising the market by buying, and that won't be there forever, and eventually will have to be sold back into the market, and you don't let people who would otherwise want to sell, anybody who might want to buy might look at the price in the market and say, gee, that's not the market clearing price. That's some higher price than what would otherwise be the market clearing price if everybody was allowed to do what they want to do, which eventually they will be. So I, a potential buyer, will stay away from this market until the market settles into its correct market clearing price. Whenever you have these funny interventions in the market, they sometimes have the exact opposite effect. If I wanted to invest in China, I wouldn't invest now, 5 minutes after the government, and by the way, maybe they did it again last night, which is what some people are thinking, because the market rose again at the end. I'm not going to buy after the Chinese government may have intervened in its own market to raise the price. So I think they don't have a lot of experience at this market stuff.
They're getting it though. But let me slowly. Why has the world economy suffered from such disappointingly slow growth for such a long time? I mean, we talk about China, they're going through a transition. Europe has just been through sort of existential crisis of the euro. We know that emerging markets are getting hit hard by commodities, but everybody looks at the US and says, wow, yeah, the US is doing well. And as you just said earlier, conditions are probably right for the Fed ultimately to start raising rates. But the data are still basically, by any historical measure, incredibly disappointing. US has averaged just over 2% growth since the beginning of the recovery in the middle of 2009. That's the weakest recovery we've ever had. Given the depth of the recession that we had, 2007 to 2009, it's very, very weak. So, and if you look at the IMF data, IMF forecasts that were made in 2009, every single country, China, the Eurozone, even Japan, the United States, every single country has significantly underperformed, disappointed relative to expectations back then. Why are we going through this protracted period of weakness?
I think the underperformance is compared to normal recoveries, not necessarily expectations. I think, if you dial the clock 5 or 6 years, there are pundits, forecast.
Well, the Fed has been consistently wrong. I mean, the Fed every single year, the Fed's forecast for growth for the last 5 years the economy's undershot the Fed's forecast.
And in Europe, people, as recently as a couple of years ago when you had the euro crisis, I think people would be happy with 1.5% growth that we're seeing on Europe. I mean, we're certainly underperforming the normal bounce back after a recession. Look, it was a very deep trauma. It was very undermining and very, very undermining of the financial system, which is really very. I don't have much to contribute here. I read the same things you do, but in the history of finance, when you have something that affects the banking system and finance, those are particularly bad, because the whole the normal liquidity that provides the fuel for growth is itself impaired, and so I think that's what happened here. I can go back and explain it. Given this, I wouldn't have predicted it from the set. I also would have thought that growth would have been greater, and that's what's generating the nervous today about upsetting it.
You point to the financial crisis. One argument, I'm going to provoke you here a little bit and see what your response is. One argument that people have is that growth has been so weak because the response to the financial crisis was overkill on the regulatory side. You've just talked about financial conditions. As a result of the measures that were put in place, the capital, the changes to capital ratio requirements, the very intensive regulation, the intensive scrutiny that financial institutions face now, there is a much, much, much reduced willingness to take risk. Leverage has obviously declined. All kinds of numbers you can use to demonstrate that, and that is this tough regulatory environment is pressing down, even in the U.S. with all of its animal spirits and all of its terrific crap. Do you think there's something to that?
Well, that's certainly a part of it. I mean, if you have to. It's almost literally a part of it. I mean, there is if you're asking whether it's contributing to the lack of risk taking, yes, avowedly so. The regulations are being designed, and the capital requirements are being designed to suppress risk. But that's also, listen, if there were no regulation and you came out of the financial crisis and we'd all been traumatized by this, I bet, there's not a room I could go into where I go into corporate room or I go into where I say, show of hands, who has record levels of cash on hand? Every hand goes up.
Right.
In other words, that trauma was very great. It was the trauma and the experience of the crisis that generated the political will to have those regulations.
Right.
Yes, they're extreme, and yes, there are costs with them. And as we get further and further away from the trauma, the kind of fear and anxiety dissipates, and the negative consequences of perhaps overdoing it weigh more heavily. And that's why there's a cycle to everything, and that's why the pendulum swings. But it's no mystery to me, if left on my own, without any regulation, Goldman Sachs would have been substantially less leveraged than it was at the start of the crisis. Right. We would have had multiples of the cash on hand that we had at the beginning of the crisis. Why? Because I lived through it. Right. And it's going to be a long time, it's not going to be me that's going to have less, I'm never going to forget that.
Your overall leverage is what? Half?
My success.
Half? What is your total balance sheet leverage? It's like
we
half.
Probably have a third more capital.
Right.
And probably
40% fewer assets.
40%, half the half the risk-weighted assets or something like that. Substantially.
Okay, so some of that is regulatory imposed, and some of it is your own decision.
Mandated. Now, one of the problems with the regulation is there's a normal anxiety, tension response. Then over time, it becomes a little bit more measured, and rationality takes over, and eventually it becomes, maybe the pendulum goes too far in the other direction again. What happened in this particular case, at the moment of maximum anxiety and resentment, laws and regulations were passed that really kind of froze that kind of worldview and the consequences of that at a moment. And so I would say, should we regulate institutions by requiring them to have more capital? Certainly. More liquidity? Yes. Less leverage? Yes. More compartmentalization so that you can, if you ever ran into trouble, you can liquidate aspects of them? Yes. Let's do them all. And so all of those things have compounded and created an environment where there's probably more risk aversion. Look, I'd love to never have to take risk and get wealthy on the side. The problem is you can turn yourself into a treasury bill, and that's what the economy could look like.
A lot of people have done.
So I think it's gone too far. I know why it did, but there's no instruction to do any kind of cost-benefit analysis or weigh the consequences of it. That will take place when the users of the financial market say, my goodness, this is getting ridiculous. I have no access to capital, or capital is coming too expensively. We're seeing places of that. Look, we're not an originator of mortgages, so I have no skin in the game, but you could see banks aren't originating mortgages because the complexity of the regulation, the consequences of making a mistake. You go out and you get an FHA guarantee and something is wrong, and you pay billions of dollars worth of penalties on what is a adequate margin business. So people aren't going to do that business. Now everybody would say, how do we get the banks into doing it? And so that pressure is not going to come because the banks are saying, this is terrible, you have to change this, it's too self-serving. The things will change when the users of the financial market can't get what they want from the financial markets.
Let me ask you about Goldman's model. After the financial crisis, the major traditional investment banks, pretty well all of them changed. In two cases, I suppose, Bear Stearns and Lehman, circumstances changed irretrievably, shall we say. They didn't have any choice. The other major investment banks, most of them pretty well changed.
Well, Merrill Lynch merged into Bank of America.
Sure, Merrill Lynch too. So, but the other ones, JPM, Morgan Stanley, sort of pursued a somewhat different model from what they've done before. You at Goldman, I think it's fair to say, stuck broadly with the model that you'd had through some criticism at the time in the early stages after the financial crisis. Is that which is the let's say the broad your trading was still going to be important to you? The traditional investment banking activities.
Right.
That seems to be paying off now. Would you say you now? I mean, having gone through a period of significantly challenging adjustment, that now seems to be paying off. Your latest your performance in the last year or so has been pretty strong.
We've had the higher
Do you,
return.
is that, you feel vindicated by having stuck with that model?
You know, for this minute. No, look, we were always, to be sure, don't forget, you know, Salomon Brothers merged into Citigroup before I mean, all these things, people, you know, firms looked at themselves and said, you know, we want to be diversified financial institutions. And so you had waves of mergers of investment banks into commercial banking, creating, you know, the collapse of you know, the separation of banking, and created financial, you know, large-scale financial institutions. Way before the financial crisis, we looked at each other at Goldman Sachs and had these very debates, which were played out in public, played out in your newspaper, about what we wanted to be when we grew up. And we decided that we were going to stay focused on investment banking. You know, within the context of our investment bank, we're highly diversified. We have asset management, we have trading, obviously investment banking, advisory, co-investing, but they're all of a stripe. They're all traditionally investment banking kind of activities. We recruit, interview at a very, you know, at a very defined set of places. We don't have mass, bulky kinds of processing businesses in our shop. We don't have, you know, so it allows us to maintain, this is how we thought way before the crisis, allows us to maintain a consistent culture, recruit at the best universities, have a relatively small firm as opposed to 300,000 people, easier to manage, simpler. When they go, you know, when the regulators go out and give capital requirements out based upon complexity, we're actually simpler because we're just really just an investment banking business. And that suited us. Didn't suit everybody, but it's what we wanted to do. And so when the financial crisis struck, we weren't driven to change our nature. By the way, we would have, if it was existential, and we had to have. There were moments in the financial crisis where I think we were being prodded and jabbed to merge with other institutions, and that never came out. I'm glad it didn't come out, but I can't say that we wouldn't have adapted to what we had to do necessarily. We were fortunate enough to be able to, the financing markets weren't closed to us.
But it sounds like you, despite your reluctance to say it, you do feel pretty vindicated. You think you pursued
I think it works out well for us, but I will tell you, in a good part of the credit cycle, when firms are minting money because they have the wind at their back because their credit card business is creating very wide margins, boy, I wish we had that. And this is, you know, so I get up every day jealous of anything that our competitors are doing better than us or wind at the back. But generally, we're not in that credit, you know, we don't extend credit. You know, a lot of the problems of the earth are from credit extension and just scale and complexity. So in general, I like where we are, but on any given day, if there are going to be no bad credit events forever, and banks are in the business of taking in deposits at low levels and getting at high level, that looks pretty good to me.
Let's very quickly go through some of the aspects of your business that have been striking this year. M&A, your advisory business has always been very strong, strongest.
Yep.
Frankly, it's been a banner year for M&A.
Yep.
Is that going to continue?
You know, the markets could close up tomorrow. You know, we wouldn't have a clue today, because some exogenous event. But based on everything I see, yes, it feels that way. First of all the stuff that's going on, it's not really liquid. Look, low interest rates are obviously helpful, and liquidity is liquidity. If the world became illiquid, it would certainly slow it down, but it doesn't look like it's going in that direction. But the deals are not generated by liquidity. This is not a private equity-led M&A boom. It's all strategics, and it's all people doing things that have compelling industrial logic. You may disagree with in the long run, it may not work out. Some of these companies may get too big for themselves. Industries may get too concentrated as a result, which is some of the criticism of some of the deals that are going on and why some of them are getting scrutinized and why they're being subject to regulatory approval as appropriate. But if you ask me, most of it is healthy, and most of it is the deals that are getting done are going to in turn drive other deals because companies are getting big. You know, just take, for example, you know, in the, you know, media space, when you have the content, you know, when you have the distributors aggregating, so they have their market power vis-a-vis the content providers, they're getting more powerful. So then the content providers get together and want to be more powerful negotiating force against the distributors who are concentrating more. All these deals are suggesting other deals. And the economies of scales and efficiencies go. So most of them seem pretty good to me, but the fact that some of them are happening suggests others have to happen in response. And there's also crossover technologies. There used to be telecommunications companies, cable companies, there used to be media companies, there used to be content creating companies. Now they're all finding reasons to integrate for efficiency and other reasons.
Let me ask you quickly about technology and how technology is changing the banking business. I know you're looking at this in a lot of detail. There's some very interesting things going on in financial technology. Tell us about whether it's cybersecurity and how much of an impact that's having on you, or the way in which trading is changing. Just give us a sense.
Well, it's always changed for years, and we always, these won't mean anything to you, but ARCA, ICE, bond book trade, and these are all platforms that change the market structure that we were very much at the forefront of and drove. So we were always very much involved in market structure and creating technologies, foolishly selling off our interest in them too soon, because it turns out that some of these market structure things and platforms become as valuable as some people's franchises in the business. And we're still doing that today. Today was some press on Symphony, which is a communication thing that's coming out today that Goldman Sachs was at the forefront in driving.
Dow Jones is involved in too.
Dow Jones, thank you very much, is partnered in content. And so that's changing. Listen, that's changing in our industry. It's changing in every industry. In fact, in some ways, the fact that you have to be a bank holding company and highly regulated to be in our space actually creates more of a moat against interlopers into our industry, and than is unfortunately for you available in your own industry.
True.
But these changes, everybody's going home in every industry and trying to figure out what's the effect of this and what's the next step and how do we get ahead of it and how do we get paid for our content, or how do we compete in distribution when other people are coming in. But we've always been doing that. We've been doing that for, our industry is always at the forefront of these kinds of changes. You walk in our trading room today. I walked one of my predecessors around the trading room floor. You can't recognize it. It used to be noisy. People used to shout at each other. You can hear a pin drop in it. Used to have hundreds of people communicating by phone. Everything is communicated, obviously by through platforms, technology, digital platforms. But actually, the prices are generated by algorithms, and by the way, and there are good consequences and bad consequences to this. Leverage goes both ways, and technology is a form of leverage. And so you asked about cyber terrorism and cyber. Look, I'll say cyber terrorism, cyber crime. How about cyber fat fingers and mistakes? Right. The world is going. They say the world is going to end with a whimper, not a bang. It would be irony, of course, if the biggest problem that evolved didn't happen because somebody did it intentionally and inflicted it to you. I'm scared of mistakes. There's leverage in mistakes now that get made. Once upon a time, you couldn't make a mistake that could. Things didn't happen fast enough for you to make a mistake that could lose tens of millions of dollars or something like that. I'm just making something up. But now, things are so complex and they're done so quietly and they're done by machine. You don't hear discordant noises and things that don't make sense. You don't hear anything at all. And they're happening, a million orders go through in a few seconds. And it happens fast. What if, so the leverage, can you lose a lot more money than that? Sure, in anything. Prior to the digital age, could a company misplace hundreds of millions, of the data for hundreds of millions of its customers? Could that have been conceivable? Right. Would that data even have existed? Right. So you can wreak a lot more havoc today because of the very technology and the leverage created by that technology that makes the world a better and easier and wealthier place. So it goes both ways. And some of that, I think that what's happening now is, some of the brouhaha in the Symphony was over, can regulators get in? Well, guess what? You are making these things more password, more protected because you need to. Not to protect it from regulators, but to protect it from from hackers. And so that's why it was so easy to sort that out. Of course, we don't want for our regulator to see it, but we're not going to get, increasingly, we're going to have to play defense on these things. What do you do about it? So how do you shield yourself against it? So will you build systems to watch other systems? Well, you're gonna eventually you'll have mistakes in those systems. So maybe do redundancy and you check them over and over. Well, checking them over and over again, if you check something 7 times, the people who are doing that 7 times become brain dead because everybody knows they're gonna get checked 6 more times. So how do you keep people alert?
Welcome to my world of editing a newspaper, by the way. That's,
But
anyway, I want to open it up for questions. I must quickly ask you, though, we're in a very interesting political season. We've got the Fed decision tomorrow. We've got an almost as interesting event tonight, another presidential debate.
Much more interesting.
It's a remarkable political race, particular presidential race, especially on the Republican side. One candidate, you know all of the candidates, I'm sure, but I'm wondering what you make of first of all, of the Republican race, in particular of the prospects of Donald Trump making America great again. You have confidence that he'll be able to do that?
I don't know. I'm listening. I mean, the first event where the first caucus is 5 months from now. I mean, if I were you, I'd pace myself on all this coverage.
Thank you for that advice.
Yeah.
We'll take it. Yeah. But I can't help it. They're out there running around the country.
What are you going to do when something happens? What I will tell you. But if it diverts you away from us, I'm all for it.
You're very happy. Yeah. Okay. Well, no, I'll just take those reporters off the presidential beat and put several of them onto Goldman Sachs.
Look, I'll tell you what I want. I'll give you my take on some of on this whole on this thing because and listen, I'm sitting. The audience is all these people, a lot of people who write the news. I just read it. So I don't think my opinion is worth any more. But I'll tell you, I look at some of the issues with Trump, and he's going out there, and he's talking, and everyone can make it, I'll get a better deal. Nobody is listening to him thinks he's ideologically stuck on the most extreme position. One of the negative consequences of this turn of the political culture that we have today, and it's not the politicians' fault, it's the electorate's fault. We're sending people to Washington with a pledge not to deviate from the most extreme position anyone can articulate. Can you imagine if this were like this? At the founding of the country, we have diverse region. Interests, ethnicities, basically melting. We put together a country and let's send everybody to Washington with an absolute pledge to never compromise on anything. And then Trump comes along and talks the language of dealing. Who thinks that Trump is an ideologue? So I'm not saying that, I'm not saying the overall picture is a good picture and I can find fault and some of those things seem wacky to me that he says and hard to imagine, imagine this, finger on the button kind of stuff.
It doesn't scare you.
Blows my mind. But I will say, maybe I'm finding in this what I want to see. I would like to find, I talked about pendulum swinging and cycles. I would like to get to the next part of the political cycle where people come along and say, God, nobody can get anything done. Everyone's ideological. Everyone's saying, God, I'm the most right-wing guy. I'm more right-wing than him, and by God, I'll never get off that right-wing border. And I'm a socialist and I'm more left-wing, and no one's going to get between me and the left border. And I would like that, and nothing gets done. Everybody hates everybody, and it's poison. I'd like it when somebody comes along and say, hey, I'm going to go there, and I'm going to get the best deal for my set of positions, but I'm going to deal. And we're going to come out with a set of rules, and we're going to legislate, and we're going to move forward and get things done. Now, I don't know that he's saying that.
Sure.
In fact, I know he's not saying that exactly. So maybe I'm allowing my fantasy life to pick up on me a little bit. Right. But I think that part of an element of support that's getting it, I'm hoping, is an implicit step in the direction off off what historically has been the strength of America is to reconcile disparate and diverse interests.
So, in a word, you could live with a Donald Trump presidency.
I didn't say that.
Quickly on the Democratic side.
Look at the stuff I've had to live with, for crying out loud.
On the Democratic side, I'm guessing from what you're saying that you know Hillary Clinton very well.
By the way, I'm a Democrat.
I know you are. I'm assuming that Bernie Sanders isn't saying much to you at the moment that you find very
No, actually, he's not saying much to us. He says a lot about us. We somehow slipped into his talking points as the emblem of course. Well, how could that be? That's probably your fault.
Yeah. You always say we're responsible for everything, Lloyd.
Yes.
Maybe there are real things going on out there that we're just reporting.
But I can't understand because I would say this, because Bernie Sanders is the guy. I'm not saying the words sound like the words I would use, but the accent sounds most like mine. We're both two Brooklyn guys.
Why is, very quickly, and I do want to open up questions, why is Hillary, once again, seems to be running into these headwinds? I mean, we saw it in 2008. She was the front runner. She lost. She's got all these problems over the email stuff. Why, you know her well. You've been a supporter of her. Why? What's the problem?
Front runner, establishment, embedded anti-institutionalism that affects everyone. Tired, wanting to break with the, we'll see what happens when people's hands start to shake and get sweaty and you get into the booth and it's really consequential. And it's one, it's like, let's go, let's leave the euro, let's Scotland secede, and let's, you can say all this stuff when you get into it. We'll see. It's got a long way to run.
You'd like to see Joe Biden in the race?
I'm not sure. Fortunately, he's probably not going to consult with me.
Okay. Questions, please. We should have microphones, I think, circulating. Yes, here, there's a lady right at the front here. Please identify yourself as well when you have the microphone. Thank you.
Good morning. Thank you for joining us today. Cynthia DeBartolo, Tigris Financial Partners. I've heard you say that the regulators, as far as your opinion is, that you consider it more background noise, almost music, and go along and do what you need to do to grow your business and be successful.
Screeching car brakes are background noise, too.
Yes, and I agree with you on that point. I spent most of my career as a federal securities attorney and compliance director. So I've also heard you add to that the change is going to come from investors. What do you think will be the catalyst?
Users of the market.
Yes, correct. What do you think will be the catalyst to make those users actually take some action?
Look, the regulation is highly consequential, and I spend a lot of my time having to deal with it. When I say I deal with it as background noise, as something in the back that I have to do, it means that I'm obligated to, work in my company, do my job, drive things forward, finance our clients, in other words, I'm in the realm of no choice, no problem. It's not that it's beautiful music that I've switched on because I find it so calming and peaceful. I have no choice. I'm living with it, but I'm not going to jump on the table and whinge about it. I know why it's there, and I know my whinging is that the world isn't necessarily ready. It's getting ready, but it's not ready to hear reason on the topic and cost-benefit analysis and alternative paths and changing and modifying Dodd-Frank, which is a very complicated piece of legislation that was thrown together very quickly, but to go in and say there would be no consensus about changing anything, even if it were compelling from a reasoned point of view, because it's not a receptive world to that now. So I've always been very pragmatic and realistic. So guess what? I'm going to cope with it. We're going to deal with it. We're going to satisfy our regulators and do everything the best we can and try to also do our jobs. That's what I meant by it's in the background. I'm not going to rant and rave about it because people just, they'll just beat me to a pulp.
Another question. Yes, at the back here. Yes, please. And again, please identify yourself.
Ivan Feinseth, also from Tigris Financial Partners. I mean, one of the problems is that companies have a record amount of cash and cash flow, and they've been taking their money and buying back stock and causing that gap in net worth. So what would you like to see done, or if you went into government service, what would you do to incentivize companies to invest in their businesses and hire people rather than just take their cash and buy back stock?
Yeah, I'll be honest with you. I don't understand this whole negativity towards companies buying back stock. If companies hoarded their cash or recklessly spent their shareholders' money by making investments that had a lower return than the investors could make themselves, and it's their money, people would be criticizing them for that. I think that companies are already incented to invest capital if they think they can get a higher return and an accretive return on that investment. Look, we're in a business now. We're not exactly, financial services isn't growing now. We're not in a position to do M&A in the business where, it's not the highest part of our cycle. We're still making money, and we're making more money than we could deploy in our business, so we're buying back stock.
No.
That seems sensible. What does that mean to buy back stock? It's not
No,
like
I like stock buybacks. It makes stocks go up. I
well,
like
not
when
forget about what it
companies
does for the stocks.
Increase their dividends.
We're returning, that money is not going into a bonfire, it's going back to shareholders, and you'll presumably, given it's your job to find good investments, you'll find other investment sources for it, and that'll drive the economy.
No, but
and so I don't see
my
what's...
point is, it's almost sad that companies don't see other places outside of buying back their own stock to invest.
We're at
to get
2%
return.
average growth rate. There's a lot of places where people aren't seeing investment opportunities.
Just quickly, let's move on. We've only got 10 minutes left. So quick, this gentleman here in this table, and then I'll come to you, sir.
Hi, Bradley Honan from KRC Research. You have spent a lot of time subsequent to the Rolling Stone article doing reputation repair. Maybe today is an
By the way, that
example.
Rolling Stone...
I'm not the only one who read the Rolling Stone article.
That Rolling Stone is not, is not one of our big, symbolic points in the life of Goldman Sachs.
I understand, and I guess my question is framed around: at what point did you and the board make the decision that the noise and the chatter from that and from other things was too intense, and you needed to go down this course of deploying a lot of your time, deploying your firm's resources to go and repair your reputation? What was the business case, and what was the decision?
What happened? I mean, really, what happened is we were entirely, and still are for the most part, an institutional firm. You're not seeing a lot of Goldman Sachs print ads or Goldman Sachs commercials in the Super Bowl. Our clients are
We'd like more of those ads, by the way, if you're interested. So.
Yeah, you're overdue for an ad.
Yeah, we are. Why do you think you're here? No.
And so we didn't really have a lot of contact with the general public, largely because we didn't think they were that relevant to our business, and the general public didn't think we were that relevant to them. Guess what? And the financial crisis, we found out we were very important to each other. And in the absence of a narrative about us, we became quite sinister and quite easy for people to deliver a narrative about us. And so we got caught flat-footed, and none of us in leadership at Goldman Sachs for the 145 years that we've been around, got our jobs because our carefully honed, media experience. That's just not who we were or what we did. But in a hurry, we had a transition, and it wasn't so much we sat around and said we have to prepare our reputation. It said, my goodness, this is not who we are or what's going on, and this is not how we think about the market, and so we have to get out there. But our culture was always, we didn't want to be in the forefront. If we did a deal, it was our client's deal. And it was their name on the tune, it was their name that was out there. We never put our name out there, and that was part of the, we didn't have our name on our building. By the way, that was convenient during the financial crisis, as it turned out. But we always try to stay in the shadows, and now, of course, that turns out not to have been helpful to us, and we have to go out. Now, what we always did was we didn't advertise, but we were always in the public debate. And to this day, we don't run ads about ourselves. What we do is we talk more about, we have a conference on China Bilateral Investment Treaty or the North American energy self-sufficiency in the that's what we're comfortable doing. We're not comfortable with saying, use Goldman Sachs, don't use the other, kind of stuff. It just grates on us, but maybe future generations will be more like that. But I will tell you, I'm still grounded in that old, more institutional world where all your clients knew who you were. By the way, our market, during the whole reputational thing, our market share never went down. It went up. In other words, our clients who knew us understood, but guess what? That was a very tiny percentage of the public, and the body politic was the ones that were having the greatest influence on us, not our traditional client base.
Thank you. Yeah, another question here at the front. If you, do we have a mic? Quick, yeah, thank you.
Thank you. Good morning. Aryeh Borkoff from LionTree. Lloyd, it's been an incredibly fascinating conversation this morning, so thank you. I want to draw on a conversation we had in a more casual setting a few weeks ago. And Goldman Sachs is a competitive financial institution around the world and really takes advantage of the connectivity around multiple markets and money flows around the world and performs at an excellent level every day. How do you juxtapose that positioning of the bank with the competitiveness of the country, and how America is now situated from a financial perspective, political parties aside, just in terms of money flows or competitiveness versus where we could be in the future or where we are we performing as well as we could be as a country financially?
Well, we're very competitive. We're doing better than everyone else. We're not as competitive as we could be because we have certain inefficiencies that we've built in, but nothing's ever perfect. If you look at, America has had always natural strengths. Ironically, some of the things that we're most worried about now, energy situation, so favorable to us. The immigration flow, so favorable. Look, during the fiscal crisis for Goldman Sachs, the thing I watched the most was, do the best kids in school still want to come from Goldman Sachs? If we give an offer to somebody and 4 other people give them an offer, what percentage come to Goldman Sachs? You could say that about the United States. If you're growing up, name the country, and you're entrepreneurial, and we deign to let you in our country, where do you go? You come to the United States, and you make your career, and you invest in that, and you create wealth in the United States, which has the multiplier effect in this country, and we're very, very well positioned vis-a-vis everybody else. It's sloppy, it's noisy, it's inefficient because it's democratic, if you will, but then it's also more stable most of the time because it's democratic, because things have been vetted and people have compromised when they've compromised. But the compromise thing is not just a matter of getting things done, it's a matter of making it more stable. If you pass something without somebody's cooperation, the next time that turns, every fiber of their being is out to, wants to reverse it, like Obamacare, like the health care. Whereas if people had, things have been compromised, it would be much more stable. But to answer your question, America is in pretty good shape, and in its economic system and markets, the envy of the world. That being said, everybody's getting wealthy, and we can't afford to carry the world, and we can't dominate the world. So we have to So there's a funny thing, we won't have the market, make America great again. What does that mean? We will not have half the GDP of the world, absent some crisis on the scale of World War II. So we are diminished in terms of our percentage of all the wealth in the whole planet. But America as an economy against other developed countries, we're the biggest and yet the most nimble and fastest growing. How is that possible?
Quick, maybe 1 or 2 more questions quickly. Yes, here, sir.
Thank you, Mr. Blankfein. My name is Sam Luft. Actually, I live in Asia, and I think the way you described China was right on. But the one question I have, which a lot of people don't discuss here, is really the impact. I believe China is still the largest holder of U.S. debt, and you know as well as I do that they're going to do what they're going to do. And as you look out over the next few years, do you worry about the impact to the U.S. Treasury market of them redeeming U.S. Treasury for bringing that money back home, and what that impact will be here?
Well, I worry that the United States is a big debtor country, and as I said, those lines are starting to converge, and so that won't necessarily keep expanding as a percent of GDP out into infinity. I'm not worried that they hold, some of these things are, very funny. I'd rather they hold our debt than we hold their debt. Really, you can't redeem. I mean, you can not roll over things, but you can sell your treasury debt if you can find another buyer, but you can't redeem it except as it matures. And if we keep having budget deficits, we will have to keep maintaining that, and it'll be expensive. So I worry about the scale of our debt, but I don't worry that China is holding it. Just like I wouldn't worry. Remember all the noise about when foreign countries were going to invest in our infrastructure and our roads. And there was I remember because I was somewhat involved, and there was somebody was going to invest in and buy the New Jersey Turnpike, and he said, how could you have these foreigners own the New Jersey Turnpike? For crying out loud, I wish the foreigners would buy all the infrastructure. What are they going to do if they don't like us? Take it home, pack it up, wrap it up. That's the best thing in the world when people buy our debt. The thing I worry most is when people owe me money. I'd rather owe money to the Chinese. They have a stake in our success.
One quick final question. Yes, sir, here at the front.
Believe me, the Chinese are more worried. In the financial crisis, they were worried about us. We weren't worried about them.
In August of 2008, I had a chance to meet with George Soros, and he had written a book, and he had predicted in the spring, I believe, of 2008, there was something big about to happen because of the mortgage-backed securities, et cetera. It was predictions, I guess you would say. There's something bad about to happen.
I think it was at that point an observation, not a prediction. It kind of started in '07.
Right. But the book had come out previously. But
Okay.
when I met him, do you see anything on the horizon where there's, I guess it was mortgage-backed securities was really the big problem. But is there anything that you can see that we might be doing that could be stacking the deck against us in the future?
I'm in the worry about low probability, highly consequential thing business, where we don't really predict. We really contingency plan, frankly. And if you contingency plan really well, when something happens, you get off the mark so quick, people think you foresaw it. But really what you are is you're responding quickly because you plan for it. I think there's a lot, I worry, we had been worried, and again we'll be worried about the euro, again, fixed exchange rates between Spain and Germany for, you have one interest rate in one Germany that both Spain and Germany have been living under for 15 years. Is that possible? And what happens, it's always a shock when bands and fixed things break apart. What can happen, what can happen there? I worry about the financing of, what if there's another crisis in peripheral Europe, where the last crisis was defeated because of the willingness of Germany to bear, and the wealthier countries in Europe to sort of mutualize some of the debt and have the ECB finance some of the debt that's been issued. But those lines continue to diverge. What happens when the question is not the willingness to finance those countries, but the capacity to finance those countries because the debt deficit becomes too big? What happens if this thing in the migrant situation? I always thought that everybody always knew that the euro was a political expediency with vast economic consequences, and so everybody expected the economics and the market stuff to be sloppy because it was done to cement the political unity of Europe. Well, now we have a situation as a result of the migrant where Europe is being, the whole concept of Europe is being attacked because of political issue. How to deal with the migrants, not even the economic issue, which is kind of ironic. I worry about the cyber, terrorism, crime, mistakes, leverage. We put one of the big advances that result of the financial crisis is to have clearing houses and to concentrate risk. Well, that'll insulate you from the 20-year storm. What happens when you have the 100-year storm and it puts the central clearinghouse at risk? What happened? There's a million there's a million reasons to be, to worry about stuff, and we try to contingency, plan for these things, but you also have to plan for that odd contingency that everything may work out, which, by the way, is I think the most likely thing in this market.
Let me take the privilege of asking you the final question. I know you're a keen student of history, and you've demonstrated that, and you're an avid reader. What have you been reading recently?
After the journal?
After the journal. Thank you for saying that. Thank you very much. Thank you for saying that. So, yeah. What are you reading? Well, that's all you need to read. But if by any chance you need,
if I actually need to learn something. If I want.
That's right. Yeah. If you want to learn something about Donald Trump, for example.
Or for example, I wanted to switch to nonfiction.
Yeah. If you try that. Yeah. Tell me So if you want to switch to nonfiction, you'd have to switch back to the Wall Street Journal. But what's your?
I read a lot. I've been reading. Every once in a while, I finish a book, but I'm always reading, thanks to technology, I read about 25 books at a time, and I put them down and I read them. I'm telling you, I've been reading the Discoverers for about 22 years now, and I've been reading the Warburgs for about 8 years now, and so I read a lot of history books. I read a lot of biographies.
Anything resonate with you at the moment in terms of anything tell you about the circumstances we're going through now and in a historical
I read a
phase?
book a couple of months ago. And I tend to, they sit in my library. I do buy the hard things because I like to see my body of work if I've read something. So I did read a biography of Andrew Jackson, and I'm thinking, could that what must people have been thinking when he got elected? Basically, this backwoodsman, unkempt and noisy, and just think, saying, he's going to cut down, get rid of the, the banking, the Bank of the United States and the system, hugely populist, following these establishment Virginian kind, figures, and we now think of it, look back and think of the age of Jackson and all this, and the direction, but what must people have lived through at the time, and could that be happening now? I mean, in other words, we're being kind of dismissive of things, but people must have dismissed that.
Thank you. Ladies and gentlemen, we've run out of time. Please join me in thanking Lloyd Blankfein very much for this morning. Thank you.